Hello, and welcome to my next NAP. NAP stands for Nonprofit Auditor Points, and I'm Irina Urishkova, your nonprofit auditor. I designed these NAPs to help nonprofits to understand better some accounting concepts. Hopefully, you will find them useful. And I am continuing series about revenue recognition. As indicated before, I decided to do this series because revenue recognition is the most confusing area for nonprofits. Why? Because nonprofits' revenue is governed by two completely different standards. One standard is 606, exchange transaction. Another standard is 958, which is contributions. In the last episode, we introduced the concept of conditional contributions. So we were saying that contributions recognized as revenue when they are unconditionally promised. We discussed what promise means, that intent is not a promise, and then we started discussing the condition. And we were saying that not all promises made the same. Some of them may be conditional, some of them are unconditional. And we said that conditions only exists when there is a barrier plus right of return the funds or right of release the funds. Today in this NAP, I want to dive deeper into these two elements because they're very, very confusing: barriers and right to release future funds. So let's continue talking about barriers. Barriers, you can think about it like a hurdle that needs to be overcome by a nonprofit in order for nonprofit to become entitled to these funds. So the barriers is something that must be achieved before nonprofit will be entitled to the funds. In other words, it's not just a guidance and it's not just preference. That needs to be done, and it needs to be very specific and measurable. So examples of the barriers could be requirement to serve specific number of clients. Again, specific number of clients. A requirement to complete a defined project milestones. Again, they need to be very objectively defined. So when anybody can look at these milestones, we can determine whether nonprofit met this milestone or not. Matching requirements. So again, very specific matching requirement, meaning if we raise $100,000, we need to match another $100,000. Requirement to achieve measurable outcome. A requirement to incur qualified expenses before reimbursement. A lot of government grants structured based on that conditional barrier. A lot of government contracts, grants require nonprofit to incur qualifying expenditures and then apply for reimbursement, because that's release that power of government to release the funds, and the qualifying expenses barrier is met. So you can see that all these barriers, they are very specific and objectively measurable. If the barrier is not specific, most likely it's just simply restriction how funds can be used, but it's not a barrier. And we talked in a previous SNAP that conditions are different from restrictions. Barriers create conditions, and if the condition exists, we do not recognize revenue. Restrictions do not determine whether we record revenue or not. We record revenue even if restrictions exists, but it just tells us how nonprofit can use funds. They restrict it for specific usage. So one more time, you can see that barriers only create, when the barrier exists, it always relates to performance. It's not just about how money can be used. it's all about how it can be accomplished. Very specific, objective, measurable. Now, let's talk about what it is not necessary a barrier. If a grant says funds must be used for education programming, by itself, it's usually purpose restriction. It's not a barrier. There is no specific, no timeline, no specific classes, duration of the class, nothing. If the grant says funds must be spent within 2025 calendar year, again, it's restriction by time, but there is no specific barrier. There is no specific performance that needs to be done by a nonprofit. Barrier requires performance or achievement. So that's when the barrier exists. Now, let's look at the second element, right of return the funds. Sometimes it's called right of release funds, meaning released by the funder. This is also important as the barrier because both elements needs to be met. Needs to be barrier plus right of return the funds. Then we have a condition. And if a condition exists, grants cannot be recognized until the condition is substantially met. So both elements are very critical, barrier and right of return or right to release. Even if the barrier exists, but there is nowhere in a letter explicit or implying that a donor does not, if the donor does not have a right to demand repayment of the funds or cancel remaining commitments, then contribution might still be considered unconditional. So again, if in a grant letter, sometimes it's very explicit or implied that donor requires the nonprofit returned funds, or donor can cancel any remaining commitments if the conditions are not met. If there is nothing like that language in a grant letter, then it's still unconditional promise, and we do recognize the full amount of revenue. Again, the condition needs to have two prongs, barrier and right of return the funds. For example, if the agreement may state, if nonprofit fails to meet the performance requirements, funds must be returned. That's a clear statement that the donor is saying, hey, you have to return us funds. Second prong is met. It's very clear. Or grant letter can say, the donor is released from any obligations to provide remaining funds if the conditions are not satisfied. It's also a very clear statement that right of return funds is actually present, therefore there is a condition. Sometimes the right of return funds is not satisfied in those exact words, but the substance understanding of the agreement makes it clear that the nonprofit is not entitled to keep the funds unless certain requirements are met. That's why reading the agreement carefully matters very much. Let me give you a practical example. Suppose the foundation awarded $1 million to build a community center to a nonprofit. An agreement says the funds must be released in installments as a condition milestones are completed. If the project is not completed, remaining funds will not be paid. That likely meets both elements because it's very clear we have a milestones to build the community center, milestones. Apparently there is agreement with what needs to be built. It's a barrier. Plus a donor can withhold any remaining funds, which is a right of release. This creates a condition. Therefore, if nonprofit receive this grant, nonprofit cannot recognize it's a revenue because it's a conditional revenue, conditional promise, and until this condition is met, meaning that milestones are met and funds are released, then revenue will be recognized as the milestones met. Now consider a different example. Donor gives $1 million and says, we expect you to build community center, and we will read your reports to make sure that you're progressing with the with the building, but the funds are yours to keep. There is no language requiring repayment. There is no cancellation clause ties to performance. In this case, even though there are expectations that may not be true barriers combined with the right of return. So the simple not enough language to constitute the condition. Therefore, it might be unconditional contribution, but it is restricted by purpose. So nonprofit can recognize the full $1 million as revenue as soon as it's promised, but it will be restricted for the purpose of building a building. So that revenue, in the first scenario, revenue will not be recognized. In the second scenario, it will be recognized. You can see the difference of $1 million, but in the second scenario, it will be restricted. And even though it will be revenue, but it will be released from restriction slowly as when the restrictions are met. So you can see how critical it is to analyze the condition, because whether a condition exists or not, revenue recognition might be substantially affected. If a conditional grant is mistakenly recorded as unconditional, review will be overstated, and vice versa. Auditors do pay very close attention to conditional grants because they might have very material effect on financial statements. Conditional contributions are not bad. We just need to make sure that we treat them correctly in accordance with general accepted accounting principles. A lot of government funding in particular have performance-based conditions. Sometimes we call them expense reimbursement grants, but they're truly performance-based condition. So it means that the nonprofit needs to incur qualified expenses and then apply for reimbursement. So those are also type of conditions. Let's summarize the logic that we discussed today. To be conditional, both elements needs to be met. There needs to be barrier, and needs to be right of return funds or right of release funds. If both exists, we do not recognize revenue until condition is substantially met. If only one is missing, you most likely have unconditional promise and you recognize the full amount as revenue. In the next episode, we will move into multi-year grants and how unconditional promises are recorded, including present value consideration. Thank you so much. Hopefully that was useful. Thank you for being here and looking forward to see you next time. Have a wonderful day.